All right. Well, thank you everybody so much for joining us for series number 6 of our buy, sell, and hold conversation here. I think you guys are excited, right? This is the do the deal part. We spoke about getting ready, engaging buyers, and now I think finding out the right deal structure and terms, and in other words, kind of when and how do I get paid, right? So I'll flip to the disclaimer. I think everybody likes to see that here. So what I'll do is I'm going to start off and introduce our amazing panelists. After that, we're going to jump into some questions with the panelists, kind of running through some key themes. And at all times, please, if there's any questions from the audience, let us know. We would love to hear from you and answer any questions that are burning. Also, at the end of this deck, we do have information, contact information for all the panelists here. These are all experts in their fields. Please reach out to them. They'll be able to help you kind of in any of your questions and advising you and anything you have to talk about regarding selling or even buying a business. So we'll kick off. So Matt Foreman. So he's a tax counsel in the New York office of Chiesa, Shahinian, and Gian Tomasi, where he provides counsel on a variety of transactions, including the formation of domestic and cross-border structures, sales and mergers of businesses and investments, and raising capital. So he has extensive experience in a variety of SALT issues, particularly sales and use tax nexus and marketplace facilitator rules post-Wayfair. Keith D. So he's the president of Osage Advisors with more than 30 years of experience advising business owners and families of mid-sized companies and helping them maximize value through M&A and capital transaction. So Keith actually has been on both sides of things. Actually, besides an M&A advisor, he founded his own accounting firm, ran several privately held businesses. So a very unique perspective from financial operating experience to meeting goals and objectives of his clients. Andy Abramovitz. So he is the founder of Andrew Abramovitz PLLC, specializing in corporate and securities transaction law. So before that, he was an associate at Wilkie Farr and Gallagher, a shareholder at Greenberg Traurig, and a partner at Davis Wright Tremaine, all in New York. So he graduated from NYU School of Law and Brown University. He and his firm's colleagues focus their practice on company lifecycle transaction, so formation, capital raising, M&A, along with general corporate matters. Julie Lusthouse. So Julie is the founding owner of Lusthouse Law. She has a substantial experience representing franchise and business clients. For franchisor clients, tongue twisters there. She does development and structuring, preparation and registration of franchise disclosure documents, onboarding, compliance, and much more. For the franchisee clients, she helps single unit and multi-unit operators with the purchase and sale of franchises and development of territories. She's a frequent author and speaker on franchising topics and is recognized by Franchise Times as a legal eagle, having been nominated by her peers of the past 7 years as a leading practitioner in the franchise field. She's also a member of the governing committee of the American Bar Association Forum on Franchising. And while we have somebody here that is not necessarily a panelist, Andrea Cantor has been excellent in helping getting everything together, running this panel, and hopefully we get to hear from her today on some of her insight. But Andrea has 25 years of combined legal expertise in large New York City law firms and in executive positions at public companies. She's the founder of the law office of Andrea Cantor PC, where she's corporate counsel and advisor to small and medium-sized businesses. She advises companies throughout the corporate life cycle, from formation to capital raising to M&A and to exit. So she served as general counsel to companies where she advises on a variety of transactions. And Andrea graduated from the law school at George Washington and received a BA from Tufts, and also attended Harvard Law School program on negotiation for senior executives. So, as mentioned, in our last sessions, we discussed everything from preparing to sell to finding the right buyer to due diligence, practice, and more. So this session is going to cover specifics on doing the deal, from the deal landscape to deal structures, to structuring the actual deal, looking at stocks versus assets, and most importantly, and I know the big question that everybody has, how and when will I get paid? So To kick things off, I would love to turn it to Matt to kind of walk us through the definition of, stock deal versus asset deal and kind of what that means.
Thank you, Jackie. I think it's important, to Jackie's point, to sort of understand what does it mean? What is an asset deal? What is a stock deal? And they really are, in a lot of ways, what they sound like. An asset deal is when you actually sell all the assets of a business itself. The stock can be kind of broader than just the word stock, but it's going to sell the shares of whatever owns the company, whether it's the membership interest for an LLC, the partnership interest for LLP, LP, etc., or the actual stock itself, if you have a C corporation, standard corporation, or an S corporation, or something else. And I think that's important because there's some really significant differences between the types of deals, both in terms of putting together the actual documentation itself and the tax implications, which I discuss many times. The really short of it is selling the stock or ownership interest is generally viewed in tax terms as a capital transaction, and therefore the stock, the sale, the gain from the sale is taxed at capital gains rates. Conversely, an asset deal, it depends what you're selling. Certain assets are capital assets, such as equipment, property, real estate, etc., and the rest is ordinary. The reason this really matters is ordinary income rates max out currently at 37% and federally, and capital gains max out at 23.8%. So it's really, that 14% delta, 13-14% difference is pretty significant. From a documentation standpoint, stock deals are much easier. You're buying stock, you're buying the ownership interest versus listing what all the assets are. You can group and things like that, but it really can be a lot easier from a documentation standpoint to do a stock deal. And now, I think back to you, Jackie.
Yeah, and Andy, I mean, is there anything that you could add just in terms of the documentation required? Is it, that much more extensive? What's kind of the expectation and the requirement on that front?
Yeah, I mean, ultimately, the documentation, you think about it in terms of what's actually happened, as Matt alluded to. A stock deal, it's basically a simple, transfer of the membership interest, the transfer of the stock. And for an asset deal, it's literally the listing and individual transfer of every asset. And, some assets require specialized procedures, like with IP, so that as a result, there's more documentation. Having said that, the main agreement, operative agreement in each case, the asset purchase agreement or the stock purchase agreement, is basically similar in structure. So it's more the sort of ancillary listing of assets that adds to the complexity of an asset transaction.
Makes sense. Thank you. And Keith, I mean, from a non-legal perspective, how should business owners think about this, or what should they be thinking about when given these two options? And are there certain industries that, one works better than the other?
So the first thing a business owner should do is do their homework on what's the difference from a tax perspective. Business owners, they want to do a stock sale, about capital gains. Buyers want to do an asset sale, limit liabilities. But a business owner should know the differential between an asset sale and a stock sale. So the key thing here is to do their homework, have their accountant or hire to do a tax study to understand the differential. It may not be that material, and if it's not that material, they may be able to get more value on an asset sale than a stock sale. So the first thing, for example, we have a deal right now. It's about a $15 million value, enterprise value under 11% tax, and we had recommended our client do an analysis between a stock and an asset deal, and it turned out that the differential was much less than they thought. So it put us in a much better negotiation position and comfort. There was many shareholders, 6 shareholders in this company, and they were much more comfortable. Say, okay, it's a couple $100,000 more on an asset deal, but maybe we split the difference. We got a deal and move forward, right? But if you don't know what the difference is, you don't know how to negotiate that when you're in the heat of the transaction between the buyer and the seller. And the other thing I think owners are going to think about is if it's a stock sale, the buyer wants potentially wants some additional protections at closing. Those are because they're assuming liabilities that they normally wouldn't assume in an asset sale. For example, payroll tax liabilities, workers' comp liabilities, things that are typically excluded. So the buyer may want to set up additional escrows, which means part of the purchase price is going to be set aside in a separate account that over a period of time, when say it's 12 months or 24 months, there's no issues with taxes, insurance, employee litigation, etc., then that money is released. So this should be cognizant of the fact that they may not get as much at closing in a stock sale as an asset sale because some may be held in an account and paid over time as long as they meet certain requirements.
And are there certain industries that it's definitely or definitely the other, or does it really just depend?
Well, it depends. I think also need to be consideration. For example, if a seller agrees to an asset sale and they're heavy machinery equipment, but that machinery equipment has been significantly written down, how the asset allocation of that machinery equipment at closing could affect the tax implications to them. So we typically write in our letters of intent that the buyer will not write up the assets to cause undue tax implications to our client. And that came up. We literally had that agreed to in a letter of intent, and we got close to closing. We got the asset allocation schedule from the buyer, and we said, hey, wait a minute, this is going to cause our client $1 million in additional taxes. And we pointed to the letter of intent, which they agreed to, and they said, you know what, you're right. And it basically the asset values that were on the books at the time. So you really got to make sure you understand those things. It's critical that you document those in your in the letter of understanding, letter of intent, etc.
Excellent. No, great feedback. And Julie, I mean, from the franchise side, I mean, the franchisee, franchisors, I mean, could you walk us through, kind of how that structure is put in place?
Sure. Thanks, Jackie. I think initially what the seller should understand is that the sale is going to be subject to their franchise agreement. And the franchise agreement is going to define transfer, sale, assignment very broadly. It's going to include the sale of stock. It's going to, in the franchisee entity, it's going to include asset sale by the franchisee entity. It will include an assignment or transfer of the franchise agreement. Pretty much any sort of transfer that's occurring is likely to be included in the definition of a transfer under the franchise agreement. And as a result of that, it's not going to matter whether it's an asset sale or a stock sale. The seller and buyer are going to have to comply with the franchisor's conditions in order to obtain the franchisor's consent. And some of those conditions are going to include that the seller can't be in default under the franchise agreement. Sometimes the seller must make sure that they're not in default or they don't owe any money to suppliers at the time of closing. The parties are going to have to pay a transfer fee to the franchisor. Franchisor doesn't care how it gets allocated between the parties, but they're going to have to pay to the franchisor. The buyer is going to have to meet the then current standards for franchisees and may have to upgrade the business at a certain amount of time following closing in order to ensure that it complies with standards. In addition, the franchisor is going to have a right of first refusal, which kind of raises some issues for the parties as to when do you tell your franchisor that you're looking to sell your business. So for some sellers and some systems, it might make sense for the seller to first talk to the franchisor and determine, are they in acquisition mode? Because a sale directly to the franchisor is going to be a much simpler process for the seller than if they're going to market. But the problem is they may not want to tell their franchisor that they're thinking of leaving unless they know they have a really solid deal in place. So that's an issue for the seller. For the buyer, they're going to want to make sure that the seller tells the franchisor as soon as possible because, as I said, the buyer is going to have to comply with certain requirements. And there's going to be a whole process for the buyer to go through in order to get approved. So the parties, want to kind of run that track parallel with the due diligence and the closing process for the deal so that they don't get all the way to the end and they're ready to close, but then the franchisor has to go through steps to approve the buyer. And I would just say that from the perspective of the franchisor who's selling, there are some differences in terms of their ongoing disclosure requirements after closing and so forth. If the entity, franchisor entity, is remaining the same, and simply, ownership of that entity is changing, it's a little bit of an easier process for the buyer to continue selling franchises after closing than if it's an asset purchase, asset sale.
Okay, so it's not necessarily changing the value of the business, but the implications of paperwork and potentially future future strategy, right?
That's exactly right.
Wow, interesting. And then, Matt, I mean, this is, right, tax right up your alley. I mean, what are some of the big implications of the stock deals and asset deals, especially during the deal and even kind of, post close? How should people really evaluate this?
Yeah, thanks, Jackie. The biggest one, which I already talked about, was the different rates. There's two facets to that. The first one is the actual rates themselves. Obviously, ordinary income is higher. I know a lot of people are nervous about how taxes are going to change, and yes, both rates could go up. I don't think they're going to go up as much as the quote unquote proposals. I think those are things that are unlikely to fully happen. But the brackets also really matter, because if you've held a business for 30 years, selling the stock and selling the assets, can have very similar implications, but also brackets matter, because if you're selling a business for $40-50 million, the bulk of it's going to be in the maximum rate, the highest possible rate. If you're selling a business for 800,000 or $1 million, the rates are actually set up in a way that the results, as was mentioned before, are not going to be as different as you think. The actual amount you get is not going to be that different. And also, I think it's important, and I know this has been mentioned before, is sometimes, for tax reasons, purchasers are willing to pay more for asset deals. And the large reason is because then you buy the assets and then you can start depreciating or amortizing the assets over a number of years. It could be anything from immediate depreciation with bonus today to 15%, especially if you have a business that's very heavy on self-created intangibles, whether it's know-how, goodwill, a patent, a copyright, or if you're to go back to Bob Dylan a few days ago, sold his entire musical library. If he sold that, if he did that as an asset sale, which most likely it was, that can be, that they can be capital gains, tax capital gains rates, which can be huge, and the purchaser can then amortize it, basically get the money back by decreasing their taxable income. So it can be really important, and that's where it is. Both the buyer and the seller can have a big one. And one other point that I'll mention, I'll get into more detail if we have time at the end, but there's what's called qualified small business stock. And if you do a stock sale and the business from the start has qualified based on certain industries, size of business, etc., you can actually not pay tax on pretty significant swaths of the business itself. It requires a stock sale, it requires being serviced certain industries, largely not service industries, so financial services, law, medical, things like that are not qualified, but software development, I know we were talking about, a lot of software as a service businesses, or businesses that manufacture a lot of things can be really good. So, it really depends on asset versus stock. In general, stock is lower, but asset sales, sometimes you can get more money because it's better for the purchaser.
So, and Keith, just to jump over to you quickly. So do you see that, asset deals or stock deals, like they go for a premium? I mean, does that affect the price, or is it just kind of an ancillary, piece of the deal?
So it could have an effect on the price, and usually does. The buyer's always assessing risk, and on a stock purchase, and they're assuming, even with escrows and protections and whatnot, they're assuming additional risk. So they're going to factor that into what they're willing to pay, which means they're going to reduce the price. In addition, as Matt mentioned, they're not getting the tax benefits of an asset purchase, where they're allowed to amortize or depreciate or write off the assets over time, reducing their own tax implications. So they kind of factor that into it. And there's a lot of buyers that, frankly, won't do a stock purchase. And it could be industry specific, or it could be just the nature of their fund. If it's a private equity fund, they're just not going to do a stock purchase. So it may limit the type of buyers that are attracted to your business and what they want to pay. So, so for example, we have a deal right now where our clients want a stock sale, and the buyer's willing to do a stock sale, but he's reducing the price by $1 million to do a stock sale. So, my client's got to make a decision what makes more sense to him, what the tax differential is, what the delta is, and we try to bridge that gap. So, it has an effect on prices. Typically, as Matt alluded to, you're going to get potentially a premium on an asset sale versus a stock sale.
I mean, and Andy, it'd be great to hear from you. I mean, I know we're talking about risk and we're talking about pricing. I mean, how can you protect yourself against, these unexpected liabilities when it comes to, stock deals or asset deals, and keeping an eye on that stuff?
Yeah, thanks, Jackie. I mean, even though, the primary disadvantage of a stock deal is that the buyer is effectively assuming the target company's liabilities through its its full ownership of the company. The buyer and seller can contractually agree through the stock purchase agreement on a mechanism to compensate the buyer for unexpected liabilities. When the seller is told that the buyer wants these protections, the seller can object and say, "What are you talking about? I'm trying to sell my company and not have to think about it again." And so the parties end up meeting in the middle by having the seller's obligations to protect the buyer be limited in nature. Specifically, this is all done by having a seller in the agreement make very detailed representations and warranties about its operations in the stock purchase agreement. In essence, the agreement is saying that the buyer is paying whatever the agreed price is on the basis that all of these things stated in the reps and warranties are true. If one or more of them turn out to be untrue, then the buyer didn't get what it bargained for and deserves compensation. And in the stock purchase agreement, the procedure for that is called indemnification. So the indemnification provisions in the stock purchase agreement, they outline how the seller's obligations are limited. For example, and Keith alluded to some of these points, there's a time limit on when a claim can be brought by the buyer. It's, say, 12 to 18 months, on the idea that that's long enough for the buyer to figure out what was wrong with the business, what was wrong with the seller's representations. Also, there's negotiations about dollar limits on the total amount of indemnification by the seller and those sorts of things. And there are also customary exceptions to these limits, however. For example, if the seller has committed fraud, they're not in a position to be saying that their liability should be limited.
Great. So it seems like a lot to think about. Thank God, we have your contact information down here to discuss. But let's make a shift here. So going from the deal structure to the terms. I know all deals are different, but when it comes to when can business owners expect to get paid, and what are some of the ways they can get paid? Matt, it'd be great if you can kind of walk us through explaining the cash on close, earnouts, some seller notes, and all those good details that are usually the first thing people think about.
Yeah, well, the first one's pretty easy, right? Cash on close. How much cash do I actually get on close? And that's important. That's just how much do you get, right? That less tax, that's your net. An earnout can be done in two different functions. The first way it's done is the more common one, and what it is basically is the seller saying, "Look, my business is worth more. You're going to get this much extra business. I know the sales are going to keep up. We're going to keep this thing." Or during COVID, they've dipped, but they're going to come back. And just based on some metric, right? Earnings, free cash, however you want to do it, over a number of years, you're going to get more money. And that's really just a purchase price adjustment to the purchase price. Also, there are earnouts. Sometimes the seller becomes an employee of the company and has certain bonuses in their contract itself, their actual employment contract, that says, if you hit these certain milestones, depending on the business, they'll get a contractual bonus. That's a wage. It's taxed at ordinary income rates, so it's actually a little higher taxed, but that's something that people negotiate between. The last one is a seller note. And what this is pretty common in a number of industries. And what basically happens is over a number of years, the price is 100 million, just to give a number. They'll pay a certain amount on close, and then they'll pay 10 million a year plus interest, because it's a note, it's a debt. To the buyer will pay to the seller because of the note, and they'll get their money over a number of years. There are mechanisms that if this defaults, the seller can either force payment or take back the company, which it has a risk. The question is always, does the seller really want to take back the company? Which goes back to questions we've asked probably in every single one is, why are you selling? Why are you, what's the goal? And that's really important. And those are, largely the ways you can get paid.
Great. And with the environment changing, especially this year with COVID, and there's a lot of uncertainty going forward. I mean, Keith, looking at deals that hit your desk, have some of these structures changed of, traditional, here's cash on close, thank you for the business, to perhaps maybe more seller notes?
So the answer is deal structures have changed significantly due to COVID. The main reason is trying to bridge that gap of what the company was worth pre-COVID, what's it worth today, and what it could be worth back down the future after COVID. So things that were never would be considered like earnouts are now standard. For example, if your company was worth $20 million on February 1st, but you had a dip in revenue and in profitability because of COVID, and today it's worth $15 million. So the buyer's still willing to pay you the $20 million, but they'll pay you the $50 million today. They'll structure an earnout that works for both parties, and you'll stay on for a couple of years. Could be 1 year, 2 years, 3 years. And if you achieve those certain milestones, you get paid out your full $20 million. So that is a big component that earnouts were used as a gap measurement for some deals. Now almost every deal. In fact, we have 3 deals in the works right now. We're working through LOIs with 4 buyers, and they're all willing to pay out over time. How we structure that works for sellers they're comfortable with is the key factor. So we're trying to marry the valuation gap with our clients' comfort level in achieving those future goals that work for them. So that's certainly a main consideration. I think it's going to be in deals for the next couple of years.
And do you see in all of those deals that the seller has to stay on, or is it just reliant perhaps on, the seller is no longer active, but based on the industry growth and the company projections that they can get paid, right? So do they have to be in the business to actually get that earnout?
So the answer is they don't have to be in the business, but we recommend that they stay in the business. I mean, they're taking some money off the table today, right? But there's a big chunk still sitting there. And they want to have some kind of control over achieving those goals. They're the owners of the business. They've run this business for 10, 20, 30 years. They know how to get the business back. They know all the methods, and they have the relationships with the customers, new business, etc. So they can get back to that. So, someone who wanted to retire may now spend another 1 to 2 or 3 years in the company. It has to be full-time. Full-time year 1, half-time year 2, maybe a third of time, in year 3. But if they want to achieve the full earnout, they should participate, sign a management agreement, employment agreement, stay with the company over the next years, 1 or 2 or 3 years, to work towards getting that earnout piece of business.
Yeah. And then Andy, what about from the buyer's perspective, right? I mean, relying on the earnouts, and how does it work, and what are the risks to that, right? I mean, we heard from the seller side, but what about the buyer side?
Just to step back about how it works, sort of mechanically. The details of an earnout are in, the part of the agreement that deals with the payment of the purchase price. So it'll talk about what's being paid at closing, whether there's a seller note, like we discussed before, an escrow to cover liabilities. And then it goes on to say that there are these potential earnout payments that are, made to the seller based on whether the specific conditions are met. It could be a formula, like the amount by which earnings for the business exceed a target. And it could be a specific agreed amount if a particular milestone occurs. And, the risks, both parties need to think about, the concept is fine. It helps bridge the valuation gap, but it needs to be calculated carefully that whatever unexpected events occur, people are, the bargain is still, the buyer is still paying a fair amount. And as you alluded to before, the seller is going to be nervous about having control over the events that generate the earnout. So to the extent they're involved in the business, that would help.
Yeah, and I can see, both from the buyer and seller perspective that, if it is they're relying on an earnout, and, if perhaps the industry booms, what is that? Do they get paid more? If the business does better, what are some of the implications that you've seen on that?
Yeah, the buyer could potentially be solely responsible for the improvement of the business. They could be buying additional businesses immediately after this closing, and the seller didn't do that and doesn't necessarily need to benefit from that. So the buyer needs to think about protecting against that.
Great, thank you. And Julie, from the franchise side, do you see a lot of seller notes, a lot of earnouts? Are there different rules and regulations or just structures in general that this specific industry plays by?
So I'll say maybe. Really depends on the franchisor. So initially, I will say that the franchisor likely has the right to review the purchase agreement and determine if the price and terms are not so burdensome as to, quote, be detrimental to the buyer's operation of the business. And often the franchisor has complete discretion to make this decision. So while the parties can come to terms, the franchisor may have a say about them. When it comes to the seller, a seller note, in my experience, that's not uncommon. It's certainly doable. Sometimes some franchisors will require the seller to enter into a contract with the franchisor, subordinating any obligation of the buyer to pay the seller to the buyer's obligations to pay the franchisor. And so in that event, the seller has to understand that if there's not enough money to go around, they're not first in line. So that can be an issue for a seller. And with respect to the seller kind of sticking around, I think that's a bigger issue for some franchisors. They don't want the seller around. They're going to train the buyer. They want to make sure, if the seller has bad habits, maybe it wasn't a great operator from the franchisor's perspective, they're not going to want the seller's involvement. But other franchisors who may not be, as aggressive with their training program may think, sure, do whatever you want to do. So it really depends on the franchise system as to whether or not the parties really have the freedom to enter into this kind of deal or not. But I do typically see, some sort of earnout or seller note, or it certainly happens. It's just a question of whether you also have to sort of accommodate the franchisor a little bit.
And have you seen any specific trends, maybe during the time of COVID that hadn't been done before, in kind of a franchise space, or is it just M&A business as usual?
Well, frankly, the trends that I've seen have been more about, watching to see which industries have, done really well, surprisingly, or maybe not surprisingly in hindsight, and the others that are really struggling. Obviously, we have our gyms and our dine-in restaurants and our recreation facilities where they're really suffering. But some of the grab-and-go quick service or sign businesses, I've seen a lot of franchise sales and signs, because everybody needs COVID signs. So it's been really interesting. And now what I'm seeing are deals involving real estate. If, buyers are thinking that they might be able to get, good opportunities if they need real estate, now might not be a bad time to start those kinds of deals.
Yeah, really interesting. and still, right, we've been talking about the theme of uncertainty and risk, but I think with every crisis comes an opportunity, and I think, people are looking out for that. And Matt, to throw it back to you for, another tax question, what are the implications on earnouts, and seller notes? I mean, it's okay. Well, if I'm taking this home, at full price and cash on close, now what does it mean? And I know I'm getting paid interest on it, but does it get taxed differently?
It can. The answer is, it depends, right? I wouldn't be a lawyer if I didn't say that. So, the general answer, cash on close, capital ordinary. If you talk about earnouts, if an earnout is simply based on how it is, the earnout amount itself is going to be capital, because what it is you're basically saying, look, we know that the purchase price is at least 30 million. It could be another 20, 30 million. Sometimes there's a cap on it, sometimes there's not. Depends on a lot of factors. That's basically saying over X years, you're going to get paid Y dollars more. And that's basically going to be an adjustment. And the way that you look at it from a tax perspective is you sort of look at it post hoc, right? After everything is done, you're saying, okay, well, I just got 30 million on day one and 5 million a year for each of the next 3 years based on your earnout. So that's going to be, that's the total amount, that's capital gains. Any delay, sometimes there can be interest imputed on a payment, and that interest that's going to be imputed on it is actually going to decrease the purchase amount a little bit, and then the interest amount is going to be ordinary. So it goes from what's probably capital, assuming you're buying stock, of course, or an asset deal where you're buying an asset, and that's how that's going to work. And then for a seller note, basically the seller note itself is going to be really the same. It's going to be capital gains, and then the seller note's always also going to have interest in it. So that's interest is always ordinary. There's no ways to convert it. There's a lot of ways people try and dream up, but the IRS does a pretty good job of sort of, if and when they realize what's happening, saying no, this is not it. So it's a lot of times the implications are largely set, whether it's capital or ordinary, and the timing of it. The question is how much and when, and that you figure out as you go.
Great. Thank you. And what we're going to do now is we're going to turn it over for any questions from the audience. Please do add questions in here. And what I'll do is while we wait is I'll kind of throw a question out, right, for any buyer or for specifically sellers, right? Is creating earnout, is that an art or a science? Are there caps on it? Andy, can buyers take part or sellers take part in that upside, perhaps getting on the side of a little bit above what the what the original standard earnout is?
There's really it's basically everything's up to negotiation between the parties, and as we discussed before, there's a risk to the buyer in overpaying if the conditions that generate the earnout are met primarily through their efforts and not what the seller did over the years. So there's no form. People always talk to me about form agreements. There's no form earnout. There's just lots of ways to do it, and it depends on the circumstances, the negotiating power of the parties.
And Julie, is this something that you would see from perhaps somebody in the franchise space? They know they got this great location. It's an up and coming neighborhood, and they see kind of the trajectory. Well, eventually the expected, the profits will skyrocket. Is there, how long would some of these earnouts last for, and can these sellers partake in some upside?
So maybe, I think what the seller needs to, remember, and probably does if they've been operating in the franchise space, is that they're really in some ways not selling their business, right? They're selling the agreement to go away and maybe some hard assets, because ultimately the customer base, the goodwill belongs to the franchisor. And while the buyer and seller can sort of allocate cost or purchase price to those items between the two of them, the reality is when the franchise agreement is up, whether it's the seller's agreement and the seller's done, or when the buyer, has acquired the business and then they're done with their business, they don't have anything really except maybe some hard assets. The customer base, as I said, will belong to the franchisor. So, one of the things is what's the term of the franchise agreement? If it's a 5-year term that the buyer has to operate the business, then, maybe that's it. Maybe there's a renewal term, maybe there isn't. Typically, we see a 10-year term in franchise agreements, or at a minimum, a long enough time for the investor to recoup their investment and hopefully make some money. But it's not as though it's going to continue forever necessarily. They can't really control that, and they need to understand that that's what they're acquiring and what belongs to the franchisor.
And then Keith, one question that I would love to hear your perspective on is when should seller notes and earnouts be used? Are there certain times? I know you mentioned kind of bridging the gap, but perhaps from the seller side that when these would be a great instruments to implement.
So your earnouts could be a great tool in situations where sellers have invested heavily in a new product line or service line, and they're in negotiations with new customers that haven't received the benefit. So, for example, we have a client where they're going to be reselling a major software VAR. They have a VAR relationship, and this could turn into $20 of new business over in the future, in 2021, 22, 23, right? So our client has spent a significant amount of marketing dollars, human resources, human capital, developing this relationship. So as part of the deal, we put in an earnout on top of the purchase price that if this business comes in, that they would get 5% of that business the next 3 years uncapped. Right? The buyer came back, hey, we'll pay you $1.5 million on this business. And we'll say, limit to $1.5 million. They said, no, we'll do the deal with uncapped. So, which is going to benefit everybody. So that's a situation where future business is down the pipeline, but has not been realized yet, that the owner wants to get some value. And I think that's a tool you can use, and the buyer should buy into it because it's just going to grow the business and improve profitability. Seller notes, we're not a big proponent of seller notes because there's a lot of risk factors for our clients. Can they put their head down at night on the pillow, knowing that they're owed money by a company they don't really control anymore? But in certain situations, especially on smaller deals, they may have to kind of finance their way out of the company, and that's what they do to seller note for. So, and that's a reason they need to get out for whatever reason, either it's age related, health related, etc. So they're willing to take some risk there and help finance their own exit, so to speak.
And then, Matt, so, I did read something online that if you have a qualifying small business, you don't have to pay taxes when you sell your business. Is this fake news, or is this, something that small businesses should definitely look into?
It's true, and there's a lot of qualifications. The key on this, you have to be a corporation from the start, so you can't be any sort of pass through. You must be a business that's smaller than a certain amount. It's a fairly large asset base, approximately $50 million. So, you can start with a pretty good idea. The key qualifier, as I found, is really the business in the industry. It's taking out financial services. There's no doctors, lawyers. Doctors' offices would be phenomenal for this, but they exclude it. What happens is when you sell, there's a formula. And there's a minimum amount. It's $5 million per shareholder, and it has to be original shareholders. And that amount is just excluded from income, and nearly every state follows it as well. So if you were to sell your business for $5 million, right, it doesn't matter what you put in. There's no taxes, no federal, no state, nothing. You have to sell the stock. You can't sell the assets. So that limits the purchasers. And it definitely, I know Keith has talked about this and Andy as well, that there's a lot of reps and warranties that go into this. You have to agree on what you're agreeing on. And if you're going to have a stock deal, there's certain other things that have to go along with it. So it limits certain things, but it really can be phenomenal. If you're a company that you think your target is, we're going to operate this for 8 to 10 years, and we think we get bought out by a public companies are often more willing to buy stock, especially if they can get it at a really good price. And so the answer is, yeah, absolutely, it can be a possibility, and it's something you want to look into on the day you're forming your business. What is your entity? What is your structure? For a lot of small businesses, LLCs are still the preferred form for very, very good reason. But corporations can make a lot of sense, especially for companies that are going to generate losses for a while and might even sell before they become profitable.
Jackie, I had a client who invested in a qualified small business from the beginning, and he saved millions of dollars in taxes. And he invested from the startup phase when they were a C Corp, and we did a whole analysis. The only thing that was excluded was he had bought some additional shares from someone else. And I said, you have to buy it directly from the company. But he saved a ton of money.
Yeah, so I mean that's great to know, right? I mean, majority of American businesses, right? We're talking a small entity, so it's please, if you're a small business watching this, reach out to these professionals here. You talk a few $1,000,000 that that can make a nice difference. And I guess while I have all our probably put the grill on Matt for this one, taxes in 2021. Right? What can we expect? Should business owners be scared? Should buyers, sellers, anybody in the M&A space, give us your opinion.
Tax things are probably there are going to be changes to tax in the next few years. I think rates will go up. I think state exemptions will probably go down. I don't think, our trust in estates group will probably not love it if I say this, but I don't think a whole lot's going to change for 2021. I think that the changes are going to be fairly minor. I don't think rates are going to move in 2021. I just don't think Congress has the energy to take on a large tax bill right now. Definitely not as we hopefully start really pulling through COVID and get that into a rearview mirror. Similar to the tax cuts that happened for 2018, I could see it really happening starting in 2022 or possibly starting to phase in. Most tax cuts are not as sudden as the last set or whether they're cuts, increases, they tend to phase in. And that's important. So I don't think a whole lot's going to change. I think there's going to be a lot of focus on whether PPP is deductible. I do think that is going to happen. And I think there's going to be a couple little exclusions, opportunity zones, I think could sort of get taken away, either in 2021 or going forward. We'll see what happens. They'll get grandfathered. They're not taking it away for people who've already done it. But I think that those are really the big changes that could happen. 2022, I think it's a different question, but I think we're going to get a lot more of leadway. The first bill for what's people call the Tax Cut and Jobs Act was proposed about 7 weeks before it was passed, which is about 11 weeks before it was implemented, which is small bills don't get done like this. Every tax practitioner was just exhausted, just going through it, trying to understand it. And they've spent the last 2.5, 3 years issuing regulations. I think it's going to be a lot slower. And I think the changes are going to be less seismic. So the really short answer is I don't think a whole lot's changing for 2021. 2022, it could, but it's going to be a much slower and more smooth change.
Excellent. Well, I know we are coming to the end, but the last question that I want to throw to and hear from each of the panelists, and Andrea, maybe we could start with you, is what speaking to a seller, in kind of a 1 minute, or a 2 sentence spiel, what is the kind of main thing from your perspective that they should really kind of keep at the top of their agenda, when looking to, buy, sell, or hold their business?
I guess to have a deep understanding of their business, and in terms of, we were saying in the beginning, in terms of the structure, like if you have a business that has a lot of liabilities, you might want to structure it a certain way to exclude them out and figure out like what your long view is. If you want to remain with the business, if you want to totally exit, like if you structure it, like if you like Keith said, if there's a new line of business that you have that could result in substantial revenue, you might want to structure earnouts, and so you could take advantage of the upside. And I think those are the main things that you should consider.
Thanks, Keith. Since you were mentioned,
Well, thank you.
I'll throw it to you.
So from a seller perspective, it is, what is motivating you to sell? Why have you come to this decision? And what are your goals and objectives for the process? And sticking to those. I mean, we can talk about tax considerations, we can talk about value, we can talk about different buyers, we can talk about the market, we can talk about the pandemic, but why have you come to the realization you want to sell today or sell part of your business? And what are your goals and objectives of the sale? And so if you hit those through the whole process, and you're sitting there ready to a contract, and you met those goals and objectives from or more or most of those goals and objectives, you should feel good about it. And if you haven't, why not? You have to ask your question, why not, and what I need to improve on to get to where I want to be. Those are key factors you should always be top of mind and always think about when you're going through this process.
Awesome. And Julie?
I would say from the seller perspective, just to be mindful of the fact that the process for selling may be, a little bit more, I don't want to say convoluted, but, there's a couple of extra steps in connection with selling a franchise. But that being said, in some ways, you have this whole other market where a lot of times you can sell to existing franchisees in the system. And that's going to be a much quicker process for you because they're already pre-approved by the franchisor. A franchisor would be delighted to have operators. Some franchisors are very excited to have larger operators and fewer, larger developers and fewer operators in the system. So, it's certainly depending on your business, depending on your territory. There could be franchisees surrounding your territory that would be delighted to have your territory, who already know the system and who can step in. And the other thing to remember is that when it's a franchise business, the buyer is going to get training. They're going to be taught how to run the business. It's not on the seller to teach the buyer or to, for the seller to be concerned that the buyer is not going to know how to do this or that. One of the selling points for the seller to make to the buyer is that they get all this additional training from the franchisor and know-how and knowledge and ongoing support. So, it might make for more buyers, more opportunity to sell.
Thank you. And Andy?
Yeah, I mean, very general advice that I give to sellers, particularly if they're not in the business of selling their companies, it's a new experience for them, is to, rely on your advisors. Don't react too emotionally to, detailed questions being asked, about the business by the buyer. It's their job. They have a right to know. And it's a time-consuming process, lots of twists and turns, but be patient.
Right. And then Matt?
I think a number of people have hit on this, but it's a process, and I think that there's a lot of ups and downs and things that change, and I think it's important to understand. Sometimes if someone comes back with terms or they come back with something that you don't like, there's often sometimes they're just asking, but sometimes there's a specific reason they want a certain structure because they've had an issue with something before, and it's not your fault and it's not because of you, but they've created that. Or things take time. It takes a few days for this to get discussed, takes a few days for this. And to Andy's point, when you have to trust in your advisors, they're doing the same. They're talking to their advisors. Advisors see many more deals than most people, most purchasers. So it's about understanding, what's going on and how long it's going to take. And ask your advisors, is this a normal time frame? Is this something you normally see? And sometimes there's something you don't like that doesn't matter. And as part of the process, you just have to kind of let things go. And I know as a tax attorney, I like to button things up, very tightly on little things, but sometimes you have to accept that the buyer is only going to give you, 2 years, or they want 4 years and you want 2. And that's part of the process of negotiating and getting to the final, hopefully getting to the final agreement. And back to you, Jack.
Awesome, guys. Well, I can't say thank you enough for all of our attendees for joining, for our panelist, Taylene, who's done a great job with get everything organized, and USA 500 for supporting the event. Everybody's details are on here. We could happy to share the deck, but please, if you're selling, if you're buying, if you're in the space, this group of panelists here are just absolutely phenomenal at what they do. So please reach out and feel free to contact anyone. So that being said, thank you very much. Happy holidays, happy new year, and to a very strong 2021, everyone. Thank you so much.
Thank you.
Thank you.
Thank you.
Thank you, Jack.